Here, we're going to talk some real fun stuff today with my guests. And, I get excited to talk about financials and different things and how you could save money. Chris Fehr is my guest. He's a licensed CPA, but he has a much more of a different story than that. Chris, thanks for stopping by because you figured out that you had a different mission, even though you went to school to be an accountant.
Yeah, that's right, Neil. Thanks for having me on your program. Very, very different than your, I guess, typical CPA. I did get to start off working in accounting for the stock and bond portfolio for State Farm Insurance Company and learned an enormous amount about $100 billion of different investments that set me off on my path.
Okay, so when did you figure out it's not CPA? I want to go a different route. State Farm taught you that? You said,
Yeah,
okay.
State Farm taught me that. I actually was able to, I was recruited to be part of a team at State Farm to develop the mutual fund family that they ended up selling to the public. So we did a lot of testing. I read a lot of prospectuses, which was not a lot of fun, and did some financial modeling. And then we rolled that out to the public. But in the meantime, I was recruited by another insurance company named Horace Mann in Springfield, Illinois, to be their president of their broker dealer and their mutual fund family. So I moved over to that. And at that location, we did an enormous amount there. But after about 7 years, I realized that corporate America is really not what I'm cut out for. I'm more entrepreneurial and I want to help individuals and businesses. So that's when I went out on my own as a wealth advisor.
All right, so let's talk wealth advising for businesses today. The reason I'm interested in that because I'm a business myself, and you look at so many different people now are getting, especially baby boomers, are looking to retire and they don't know what to do with their business, right?
Right.
Some of them don't even sell it, which is crazy, right? And they don't figure out how they're going to do that. So, what do you do when you work with businesses?
Well, we do an enormous amount. It just depends upon the size of the business. If you've got over $5 million in revenue, we definitely want to look at, hey, maybe a captive insurance company might work for you so you can self-insure and make the margin that your insurance company's going to make. And for the right business, we can even not only make you money on your insurance, but turn that money into tax-free retirement money when you do go to sell the business. If you're a smaller business, we'll definitely look at compensation systems and things that you can do, the holes in the tax code. And Neil, I explain it this way, and this was stolen, not original by me, but the tax code is a series of red lights and green lights. And a red light is stop, you owe a tax. So those are the estate taxes, income tax, capital gains taxes, all of those are in there. And the industry is focused on, I cannot let my client run a red light, right? Because they'll get in trouble. They'll go to jail or they'll get, have the IRS on them forever. So what the most of the CPA industry focuses on is compliance with current tax law, which the problem is it changes every year. So really, if you're a red light CPA, which is compliance focused, all you can do is look backwards at what happened last year and try to minimize this year's taxes. But there are green lights in the tax code, which is an exception from paying the tax with someone else's money, creating deductions, using all those things that some people call loopholes that are in the tax code. And it's forward looking. It's
Right.
how do we really move the needle, save hundreds of thousands or maybe millions of dollars for businesses and families over their entire lifetime or multiple lifetimes. So it's a different focus. And it's not the CPA's fault that they're red light focused because they change the rules every year. So you can't do both, but you need both a red light and a green light CPA to help you out.
All right, so let's talk about this because there's a lot. There's a lot
Yeah,
to unpack, Chris. And
sure.
you're and I heard this one time listening to Robert Kiyosaki about
Yeah.
how businesses are able to not pay as much in taxes because of investing and stuff. This whole insurance company thing. So you basically become an insurance company, or is how that really works? It's really that because I heard only first person that ever taught me that was watching
Yeah.
Robert Kiyosaki, who I've had on my
Yeah.
show twice, by the way.
Oh, okay. Yeah, I love his book and his philosophy. It's really great. So, a captive insurance company simply means you're self-insuring. So, if let's say you're a construction business and you have $10 million of revenue every year, well, you're paying for a lot of liability insurance, a lot of insurance on automobiles, work comp, all kinds of other things, and you're maybe not paying for business interruption insurance, like happened when the lockdowns took place and many construction companies all of a sudden had employees but no revenue. So What you do is instead of paying for that insurance through an insurance company, you set up your own insurance company, send the premiums to yourself, your own insurance company, and then we'll reinsure or buy some reinsurance for a certain level for catastrophic coverages, but then you'll cover some of the incidental events that happen. And there's a deduction, a part of the tax code called 831B, and what it allows for a captive is to have a tax deduction for those premiums from your company going into your other insurance company, and then tax-free growth inside. And then there are strategies for getting that money out when you retire or sell the business so that the owner can get it out tax-free. So it's almost triple tax-free or tax advantageous, tax deductible on the way in, tax-free growth, tax-free on the way out, if done right. So it's really an exciting way to make money on the margin that the insurance company's making money on, but you're doing it yourself.
Let's talk about this. This is really interesting. Let's talk about smaller businesses that are not making 5 million or more in revenue. What do they do to kind of decrease their taxes using insurance and stuff?
Sure, sure. Well, a lot of it is compensation systems. There are Section 162 bonus plans or executive bonus plans, and you can even use some leverage for those. And what those are plans that are discriminatory, not like a 401k plan where you have to cover everyone, or a pension plan where you have to cover all of your employees. But it's using an insurance vehicle to create a tax deferred compensation or an executive bonus plan that allows for, again, usually some tax deduction or tax neutral event on the way in, and definitely tax-free money on the way out. And Neil, you can use this for key employees as well, to both golden handcuff them to your company with the promise of a large retirement plan. And if something happens to them along the way and they have an accident or die early, your company gets a key man insurance bonus payout, but their family also gets a large payout that can take, either a lump sum or up to 10 years of income that they wouldn't otherwise receive in a normal compensation plan.
So the challenges of people that don't know this, that's the thing, right? You're educating people, right? Not many
Yeah.
people know about this. Their CPAs usually don't tell them this stuff, right?
Well, yeah, they don't. And it's not like they teach this to CPAs. They don't teach this to most insurance agents anymore. These used to be very, very popular programs. And in fact, life insurance was the #1 employer benefit prior to the advent of 401k plans. But it's fallen out of favor. It's complex. And Neil, it's called life insurance. No one likes life insurance because of the name. They associate it with the guy with the plaid suit and who won't stop knocking at your door or calling you up. But it's really the hidden part of the tax code. And Ed Slott even says the #1 loophole or the #1 hole in the tax code is overfunded life insurance.
And do you think that'll ever change? The
Do I think it'll change? I don't know. It has changed a couple of times. Most recently in the 1980s, where really, really wealthy families and people were dumping an enormous amount of money into life insurance policies that had smaller death benefits and really taking advantage of that tax-free growth inside of it. Well, the IRS didn't like that. They penalized it because it was a tax shelter, and it truly was a tax shelter. So what they did is they made a requirement that there has to be a relationship between death benefit and the funding or the cash value, so that it's a realistic life insurance policy and not a tax shelter. That's Rule 7702, getting deep into the weeds. And that means you have to follow some certain basics. But most people think about life insurance as just an expense. It is up to that line of where you put money into it, but there's a whole nother level where you can stuff an enormous amount of money into a life insurance policy that grows tax deferred and can be taken out tax free during your lifetime as supplemental income, as long as it's designed correctly. And it's complex. It's very complicated strategies. They have to be administered and monitored every year, but nothing will beat it over time.
Sounds like it. Wow. A lot of stuff. Your wealth of knowledge. Chris, well, let's talk about the individual person now. We've talked business because I'm an entrepreneur. I wanted to learn those things. Now I can take that back to my good friend Alan Porter and say, Alan, oh, I want to learn more about this stuff. And I'll probably be going back to Chris.
Yeah.
But let's talk about specifically enough the individual person, how they should use life insurance policies and annuities as a really good retirement vehicle.
Sure. Well, for an individual, let's say you're not yet retired and you're still working, you can set up one of these plans similar to an executive bonus or a deferred compensation plan that we do for a business or a business owner. You can do that for yourself. And the benefits of that is it's not income limited. So if you make too much money to contribute, for instance, to a Roth IRA, you can contribute a maximum amount to a life insurance policy and then grow a bunch of money tax-free. Sometimes it's called a LIRP or a life insurance retirement plan. Great book out there called The Power of Zero by David McKnight. Chapter 5 explains this in detail. It's really simple, great book.
I've interviewed David, by the way.
Yeah,
I had
yeah,
David on
great.
my show.
Yeah, yeah.
With Alan, yeah.
Yeah, he's a great guy. I love him. But I just wish I had written that book. But those are great strategies for people. And another one is, let's say you're already retired or really close to retirement. But let's say you're already retired and you've got a significant amount of money trapped in a 401k plan or an IRA. And I say trapped because it hasn't been taxed yet. So if you've got $1 million in there, you don't really know how much is yours because the IRS hasn't taken their share, and they can change how much their share is anytime they want by Congress changing the tax rates. So it's really not yours. How do we rescue that? Well, you can use a life insurance plan to rescue that by taking the money out and instead of converting it to a Roth, converting it to a life insurance retirement plan, and designed correctly, we can do that for no taxes out of your pocket, as long as there's enough money to work with.
All right. Best place people can find information on you, Chris. Where can they go?
Well, they can go to Chris, they can go to FF, that's F as in freedom, wealthandtax.com. So ffwealthandtax.com is my website, or send me an email at chris@ffwealthandtax.com.
All right. All right. You're listening and watching the Neil Haley Show, and we'll be back in just a moment.